I'm Tedeschi Wealth Management Advisor at Perspective Wealth Planning with this week's market breakdown. We are going to take a look at the four major U.S. indexes. We are going to take a look at the equal weight versus the cap weight of the Nasdaq 100. We're also going to take a look at something that's going on inside the Russell 2000 that's really concerning in terms of companies' profitability. But before we get into any of that, let's take a look at the bigger picture. We just wrapped up Q2, and if you guys like this content, please subscribe to our channel so you can see this on a regular basis. But because we've wrapped up the quarter, I want to take a look at the bigger picture here in the beginning of this video. And I thought this could be a really good teaching moment for everybody as well. When we're looking at bigger picture charts, I see most of the people making a major mistake. So let's jump right into it. This actually is a chart of the Dow Jones going all the way back to 1900. Okay. And what I really wanted to point out for you for comparing the last 120 years on a chart, here's the Great Depression. You can barely see it, right? And if you look at what's happened here this year, look at the size of this move. It's almost 50% of the entire chart. All right. When we're looking at long-term charts, we cannot look at where every single point is equal to one another. We need to compare things on a percentage basis. And so when you're in your trading platform, you could use a logarithmic scale versus the arithmetic scale, which is what is currently set as default. And watch what happens to the chart of the Dow Jones here. Here's the Great Depression. We can see the major importance of the Great Depression, right? And how large it actually is. It's the biggest thing on this entire chart because on a percentage basis, the market moved an incredible amount. And here's where we are right now. So if you're looking at long-term charts and you're looking at every point being equal to one another, at the end of the chart where we're at right now in current times, it's always going to look like the biggest, craziest moves. Everything's always going to look like a massive bubble. Sell-offs are going to look like they're absolutely humongous because on a point basis, they are, right? Earlier this year, we saw the news headlines of the Dow's made the biggest point drop in history. The Dow's made the biggest point drop in history, right? Dow's made the biggest point rally in history. But on a percentage basis, that wasn't the case. On a point basis, it absolutely was because if we look at what we did this year, right, we had 1,000+ point moves, okay? Well, if you had a 1,000-point move back in 2008, right, the Dow was at 6,000. A 1,000-point move would be unbelievably huge on a percentage basis. But when the Dow is trading at 27,000, a 1,000-point move is not nearly the same. So if you're going to look at long time frame charts, make sure you're looking at it on a percentage basis or you're always going to have a skewed perception that what's going on right now is the largest, the biggest bubble in history, okay? And what I want to do next to really drive this home, again, this is the log scale of the Dow history, all right? And again, if we look at the way it's currently set up, you don't see anything. But when we zoom in on a daily chart for 3 years and we look at our chart, right? If I go and now change it to a log chart where I'm looking at it on a percentage basis, the chart barely changes, okay? And the reason is over a shorter time frame, the moves on the chart on a point basis are going to be relatively close on a percentage basis. So really you only need to use the logarithmic charts if you're really looking at larger time frame charts, okay? Now, as far as analysis of the four indexes, nothing really has changed very much, all right, from the last time we spoke. We have an island potential reversal on the Dow, and then we're trading inside this range. When we take a look into the S&P 500, we still haven't broken into that 3,200 resistance. We still have that potential island reversal here, and we're still trading in this range. We take a look at the Russell 2000. We are still failing at the 50s, right? 1550 failure point. Now we're running into that 1450 resistance. We've got support at 1350. So not a whole lot's changed over there. The Nasdaq, on the other hand, continues to be the monster. It continues to push higher. And here we are making new all-time highs again and again and again. Now, this looks fantastic. But when we start actually digging underneath the surface, there's a couple of things that are going on here, and we've alluded to it before, where we really looked at the large companies that make up the lion's share of the Nasdaq. 5 companies make up 20+% it really gives this unfair weighting to those big companies, which continue to have really strong years, and subsequently it changes the way the Nasdaq looks versus the rest of the market. So let's look at this data set. When we look at the equal weight versus the cap weight of the Nasdaq 100, we can actually see the Nasdaq 100 is making new all-time highs, while the equal weight cap weight ratio is making record lows this week. That is a very clear graphical representation that a few names are really what's leading us high. Now, historically, when we take a look at that, 3 months, 6 months later, we're skewed a little bit towards the negative side from a risk-reward perspective, but we're still positive a year later about 80% of the time. So it's not as big of a concern as one would think, just really quickly taking a look at the number. But what ultimately has to happen for us to continue to push higher, we need performance out of the rest of the market. We can't have 5 or 6 companies being the only things that are really leading us higher. And this is really, really clear when we take a look at the New York Composite Index, right? There are just areas of this market that just haven't come back. Energy has been extremely weak, obviously, with the depressed prices in oil. But when we look at what the market is totally made up of, right? And we look at the Nasdaq Composite Index, the New York Composite Index, we are still 20% away from those highs earlier this year. So there is a lot under the surface of this market that really is not performing well. When we look at what we're going to do going forward, we really need to pay attention to what's going on with the Nasdaq. If the Nasdaq continues to lead, we're fine. If we start to see money coming out of the Nasdaq, but it starts flowing into other areas of the market, we're okay. Where I will get concerned is if the Nasdaq starts to head lower and money is not flowing into the rest of the indexes, meaning we're not seeing the S&P 500 or the Dow or the Russell really having larger up moves. And when we start talking about the Russell, there's something that is very concerning that I wanted to point out for you guys on a data set. Let's jump in. Here is a chart of the Russell 2000 and its forward price earnings ratio. It is extremely expensive. We are more expensive than we were in the dot-com bubble over here in the Russell. Price to earnings ratio of almost 50. And the reason we're here is because nearly a third of the components inside the Russell 2000 are operating or losing money. They're literally losing money. It's over 30% at this point in time. And there have only been a couple of other times where we've seen them that high. Right? This is a concern that if these companies don't start finding a way to make profit, it's going to be very hard to continue to see growth or money rotation into the small and the mid caps if they are all, a third of them or more, are losing money. So this is something we're going to pay very close attention to moving forward. I mean, right now, the big boys of this market have been that safe haven. The tech space has obviously done very well as people continue to do everything online, order goods, off of, and delivered right to their front door from some of these online companies. That has been that major leadership, and so we have seen capital flow into it. The question is, can the small and mid-cap companies start to actually make money, and will we see rotation down? And if we don't see rotation down, it's, again, something that I am concerned of moving forward. Takeaway for today, we're going to continue to watch the leadership out of the Nasdaq, and we're going to continue to see the performance of the other 3 indexes and see if they can play some catch up here as we move into Q3. As always, guys, thank you. If you want to reach out, talk directly to me, I'm more than happy to talk anything about the markets with you. You can reach me at mtedeschi at perspectivewealthplanning.com, or you can pick up the phone and give us a call at 814-580-9881. I will see you guys next week.